The Reserve Bank of Australia looks well placed to be able to cut in February as Australian inflation comes in below market expectations. The US Federal Open Markets Committee is about to announce its first rates decision of the year, while the European Central Bank is on track to cut rates tonight. That's coming up in our 5 Things in 5 Minutes. And then in today's bonus deep dive interview, ANZ FX analyst Felix analyses market views and positioning for major currencies through 2025.
It's essentially saying a very tight range in the Aussie, but below the ranges that we've seen the last couple of years.
But first, in 5 and 5 with ANZ, markets are mixed and on hold this morning ahead of the Fed decision, which will come out shortly after this podcast goes to air. The Nasdaq and S&P 500 were down around 0.4%, while the US dollar index and the US 10-year Treasury yield were flat. Following the FOMC decision, attention turns to the PCE deflator measure of inflation in the United States for December. ANZ head of G3 Economics, Brian Martin, is forecasting a monthly PCE, personal consumption expenditure, deflator reading of 0.2% in the month and 2.8% annually.
If that estimate is correct, we calculate that both the 3-month and 6-month annualized rates of core PCE inflation, which is the key barometer really for the FOMC, will come in at 2.3%. That is very encouraging news that the deflation framework remains in place. It would put the momentum in inflation, certainly for 3 and 6 months, below the annual rate, and it would also put the momentum in inflation below the FOMC's forecast of 2.5% year on year for PCE inflation in late Q4 this year.
As of 4 a.m. Sydney-Melbourne time, the Aussie dollar was down 0.3% at 62.33 US cents, and the Kiwi was down 0.2% at 56.56 US cents. Number 2, the other major global focus is what the European Central Bank decides to do with rates tonight. Brian expects a 25 basis point cut to 2.75% on its way down to 1.5% by the end of the year.
In recent months, the annualized measures of inflation on a 3-month and 6-month basis are actually running below the ECB's 2% target. Our assessment of that is that inflation pressures, therefore, in the euro area have, to some extent, collapsed. We're seeing weakness in supercore inflation. That is inflation that is tied to the business cycle or the output gap. And as European growth remains weak, we think that means that underlying inflation pressures remain weak.
Number 3, Australia's headline annual inflation rate dipped to 2.4% in the fourth quarter last year from 2.8% in the third quarter, and that was lower than the market consensus for 2.6%. While the annual rate was its lowest since March 2021, ANZ senior economist Catherine Birch says it was pushed down by temporary government cost of living support, meaning people should focus on the trimmed mean measure.
It is really a measure of underlying inflation. This is the one that the RBA focuses more on. Now, in Q4, trimmed mean inflation printed at 0.5%. So that was in line with our expectations, and it saw the annual rate fall to 3.2%. Now, that is below the RBA's forecast for the quarter of 3.4%. And we think this is a big reason why the RBA is likely to cut the cash rate by 25 basis points at its February meeting.
Number 4, Catherine says underlying inflation should continue to fall, particularly as housing inflation slows.
Rent and the construction costs of new homes for owner-occupiers, together they account for over 14% of Australia's CPI basket. So what happens with prices there has quite a significant impact on that overall inflation. And we saw that rent inflation is continuing to slow and was slowing below trend in December. And also we saw a fall in November in new dwelling construction costs that didn't see a rebound in December either. So I think that's reflecting that softening in the housing market, which means we should see that housing disinflation continue through 2025, which will help bring underlying inflation sustainably into the target band.
Number 5, that lower headline inflation might now feed through to lower inflation expectations among consumers. ANZ economist Sophia Ngala says expectations appear to have already turned last week, according to the ANZ Roy Morgan Australia Consumer Confidence Survey.
Weekly inflation expectations fell 0.2 points to 5.0%, but this was a pullback of that 6-month high that we saw the week prior. And we'll be watching to see if that downward trend continues, considering yesterday's Q4 inflation print.
Sophia Engala there. Now, in today's deep dive interview, ANZ FX analyst Felix explains to my colleague Alex Tarrant where the market consensus views and trader positions are for major currencies in 2025, including the Aussie dollar.
It's a good piece to start the year and just get a sense of where the market is and where, I suppose, the consensus view is really for all the currencies. Let's get a sense of where people are starting from. So, thinking about consensus, there's a couple of ways that you can define it, and we've taken several different measures of consensus in our piece. So firstly, and most obviously, is just the beige approach, was looking at just what median consensus is. So the median forecast view of all the US dollar crosses for the end of each quarter. That's probably the most accessible definition of consensus. So we've taken a few other measures that we have and that we've used before. So firstly, we have smart consensus, and smart consensus is really looking at what the top performing forecasters are saying for each currency. So we're just looking at the ones who have done well over a 12-month basis, essentially. So that's smart consensus. And we also have a measure of forecaster sentiment or herding gauges as well. And this one, we're looking at how, I suppose, similar our forecast revisions are to various currencies. And if we see, for instance, a lot of very similar forecast revisions in one direction, whether it be that positive or negative, that would tell us there's a lot of positive sentiment coming in on that currency. And potentially, if it was a sizable enough sentiment, that maybe would suggest herding, at least to our herding gauge or the FX forecaster sentiment gauge. So those are the ways we sort of track consensus, looking at many different definitions, essentially. In terms of positioning, there's a few different data sets out there that people can use. Probably the most straightforward and publicly accessible is what we use is just the CFTC data, just to get a sense roughly of where markets are positioned or people are positioned on certain currencies, just to complement some of the findings we're getting from the consensus indicators that we have.
And so just looking at some of the main themes, it appears to be, or the main theme appears to be US dollar positivity. What's behind that?
Definitely, when we look at really all the US dollar crosses, it's pretty clear that the consensus view is that there'll be a stronger dollar in 2025. That's certainly quite obvious there, especially so when we look at the European area currencies as well. I mean, I guess what might be behind some of those forecast revisions and sentiment there, definitely, we've seen a very strong period of US growth and data the last couple of years as well, with strong US employment numbers, US economic outperformance. There's definitely a factor there. There's a lot of uncertainty, of course, around still tariffs, Trump's trade policy, and what that will mean for the global economy. So all that, of course, is helping the US dollar stay quite strong. And then, of course, we have global growth outside of the US being quite weak. So especially when we think about some of the negative sentiment that we're seeing on the Eurozone and the Euro, a lot of that does come down to the underperformance of European economic growth in the last couple of years as well, being quite a challenge for the Euro.
Just looking to the Aussie dollar, where is sentiment and how does it compare to positioning for the year?
Well, I mean, like I've said, we have seen that broader sort of stronger dollar story come through in our gauges, and the Aussie dollar is no exception there. So we have seen, our FX forecast sentiment gauges for the Aussie did show that there's a bit of negative sentiment there coming in now, at least from the end of last year into this year. That negative sentiment, though, isn't as extreme as we've seen on the Euro or the sterling, but still it is a negative read nonetheless on the sentiment side of things. And then in terms of what some of the other gauges are saying for consensus, it's essentially saying a very tight range in the Aussie, but below, I suppose, the ranges that we've seen the last couple of years. So roughly what we've seen in some of the other consensus measures is really the Aussie moving in quite a tight range in that sort of 62 to 65 cent space. So definitely below some of the ranges we've seen in prior years as well. So overall, I suppose, negative sentiment on the Aussie, but not extremely so as with other currencies as well. And that sort of broadly aligns with some of the maybe market indicators that we're seeing out there as well.
Felix there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, January the 30th. Catch you tomorrow with reaction to the Fed's decision and the result of the ECB's expected cut tonight. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.